Okay, good morning, friends. Let's start writing the summary of the last class. So, in the reverse order, last pages, go to the last pages of your notebook. Question number 1. Question number 1. Simple problem on calculation of cash flows. Simple problem on calculation of cash flows. Simple problem on calculation of cash flows. Hyphen no special adjustment. Simple problem on calculation of cash flows. Hyphen no special adjustment. Question number 2. Question number 2. Consolidated format for calculating all techniques. Underline that. Consolidated format for calculating all techniques. Consolidated format for calculating all techniques. 8 columns. Year, cash flow, year, cash flow, cumulative cash flow, year, cash flow, cumulative cash flow, depreciation, PAT, depreciation, PAT, PVF, DCF, CDCF, PVF, DCF, CDCF. Payback equal to base year plus unrecovered cash flow of base year plus unrecovered cash flow of base year divided by cash flow of next year. Divided by cash flow of next year. Next, discounted payback equal to base year plus unrecovered discounted cash flow of base year, unrecovered discounted cash flow of base year unrecovered discounted cash flow of base year divided by discounted cash flow of next year, divided by discounted cash flow of next year. Then ARR on initial investment equal to ARR on initial investment equal to ARR on initial investment equal to average PAT by initial investment into 100. Average PAT by initial investment into 100. Average PAT by initial investment into 100. ARR on average investment equal to ARR on average investment equal to ARR on average investment equal to average PAT by average investment into 100. Average PAT by average investment into 100. Average PAT by average investment into 100. Average investment equal to opening plus closing closing in bracket salvage value, opening plus closing in bracket salvage value, opening plus closing whole divided by 2, opening plus closing whole divided by 2. NPV equal to present value of inflow minus present value of outflow. NPV equal to present value of inflow minus present value of outflow. Present value of inflow minus present value of outflow. Profitability index equal to profitability index equal to present value of inflow divided by present value of outflow. Present value of inflow divided by present value of outflow. Present value of inflow divided by present value of outflow. Question number 3. No special adjustment. Question number 3. No special adjustment. Hyphen similar to question number 2. No special adjustment. Hyphen similar to question number 2. Similar to question number 2. Question number 4. A capital budgeting decision can lead to increase in revenues. Capital budgeting decision can lead to increase in revenues. Increase in revenues in bracket revenue enhancement. Can lead to increase in revenues in brackets revenue enhancement or reduction in costs. Increase in revenues in brackets revenue enhancement or reduction in cost in bracket cost reduction. Or reduction in cost reduction. Both decision will ultimately lead to increase in cash flow. Both decisions will ultimately lead to increase in cash flow. Will ultimately lead to increase in cash flow. Will ultimately lead to increase in cash flow. Next point. In this problem, savings and wages. In this problem, savings in wages and scrap, savings in wages and scrap will be treated. Savings in wages and scrap will be treated like incremental revenues. Will be treated like incremental revenues. Will be treated like incremental revenues. Clear? Any doubts? This is what we have done in the last class. Today we'll start with IRR analysis and then I get into the other comprehensive questions. Now what is IRR is? IRR is basically the rate of return. When you do this NPV calculation, if you get NPV as positive, it means it is generating a return which is better than cost of capital. You will understand this in some time. So what by definition IRR means is, IRR is basically the R which you use in your time value of money. In time value of money, you say future value is equal to present value into 1 plus R the whole power n. That R is IRR. R present value of perpetuity equal to perpetuity amount divided by time value of money or cost of capital. That the time value of money or cost of capital is called as IRR or your R. That is what we are going to do. Now there will be three types of problem. One type of a problem where there will be single cash flow. That is, they will give you a present value, they will give you a future value, they will ask you to calculate R. Whatever I did in time value of money, I am exactly going to repeat it here if they are just asking from a single cash flow point of view. When it's multiple cash flow, there is going to be a guess method of getting to the IRR. So I'll explain that in some time. Let's first start with question number 1. Find the IRR of a project with a cash outflow of 5,000 in year 0 and a cash receipt 1 year later of 5850. Okay, in this question, how many inflows, how many outflows? How many times inflow is happening, how many times outflow is happening? One time outflow of 5000, one time inflow of 5850. Now let's first write the year and cash flow structure. So write two columns, year and cash flow. Year and cash flow. Year 0, year 0 5000, year 1 5850. Any problem on capital budgeting, the starting point is getting the year and cash flow structure. So till we get year and cash flow structure, we cannot do any of the techniques. So here the year and cash flow structure is available, which is year 0 there is an outflow of 5000 and year 1 there is an inflow of 5850. Clear? Any doubts on this? Any doubts on this? Year 0 outflow of 5000, year 1 inflow of 5850. Now let's put this in a formula. Future value is equal to present value into 1 plus r the whole power n. Future value is equal to present value into 1 plus r the whole power n. The value which I am going to receive in future is equal to 5000 1 plus r the whole power 1, because you are receiving it in the first year. Let me know what is r now. 1 plus r the whole power 1. 5850 is equal to 5000 into 1 plus r. $5,000 into 1 plus r. 17%. Any doubts on 17%? Now let's write the cash flow of 5B. Now you tell me the year and cash flow of 5B. Any doubts on 17%? In the second problem, what is the outflow? Year 0, 20,000, then? Okay, year 1, 0, I am not writing it. If it's 0, let's leave it. Then? Year 2, 25. Again it's a single outflow, single inflow. There is a one time outflow of 20,000 and a one time inflow of 25992. Any doubts on the same formula? It will become 1 plus r square. It will become 1 plus r square. If it's cube and all, then we'll need the table values to get to the answer. Cube we cannot get it in the calculator. Future value is equal to present value into 1 plus r the whole power n. 25992 equal to 20,000 1 plus r square. You can finally write, when you get r equal to 14%, IRR is equal to 14%. That alone you write it. It's IRR basically. Done. Can you proceed? Now third one, find the IRR of a project with the outflow in year 0 of 50,000 and which produces perpetual inflow of 8750. So it's a kind of a perpetuity which they have given. What is the formula for present value of perpetuity? Perpetuity amount divided by interest rate or time value of money. Now write present value of perpetuity equal to present value of perpetuity equal to of perpetuity equal to perpetuity amount divided by interest rate in bracket IRR. Present value of perpetuity equal to perpetuity amount divided by interest rate in bracket IRR. What's the present value of perpetuity? What is the initial outflow? 50,000 is equal to, every year we get 8750 by IRR. IRR is 17.5%. Clear? Can you proceed? Now coming to the question D. Any doubts till now? Find the IRR of a project with an outlay of 50,000 and a 4-year annuity inflow of 15,500. So this is where I'm going to explain that guess method of doing the calculation. It's 50,000 for the first year, that is initial outflow, and then 15,500 for a period of 4 years. Just a minute. Okay, let's first write the year and cash flow structure. Now write year cash flow, year cash flow, year 0, 50,000 outflow, 1 to 4, inflow of 15,500. Okay, now please listen. I'm writing it separately for some purpose. I'll explain to you. You will write it together later on. Now, minus 50,000 is your initial outflow. Every year we get 15,500. Now, I need to start calculating NPV to this. So, let's assume I start with 10%. 1 divided by 1.1. Again divided by 1.1, it goes on like this, and you do DCF calculation. Now it is showing a negative NPV of 867. I need one positive NPV, one negative NPV to get to the IRR, or in short, I need an NPV at which the need an IRR at which the NPV is going to be 0, or need the discount rate at which NPV is going to be 0. Now, in your case, you don't know whether to start with 10%, 15%, 20%, because I should try to get a more or less the exact answer, more or less a closer answer, so that I get one positive NPV, one negative NPV. Now, in a real world, if I want IRR, it is like this, equal to IRR, and I'm done with the IRR calculation. So the real IRR in this case is 9.20%. If I discount at 9.20%, I'll get 0 NPV. If the discounting is done at 9.20%, more than 9%, you will generate negative NPV. Less than 9.2%, you will generate positive NPV. For example, if I do PVF at 9%, which is 1 divided by 1.09, now as a concept, IRR basically tells you that if you discount at a rate and you get a positive NPV, it means your IRR is better than the discount rate. At 9% we are getting positive NPV. Just a minute. At 9% we are getting positive NPV. The NPV is 215.658. At 10% we are getting a negative NPV of 867. So in one case we are getting positive NPV, in the other case we are getting negative NPV. IRR is somewhere going to be closer in between this. That's why we need one positive NPV and one negative NPV. Now how do we solve this from a problem point of view? What we are going to do is, we are going to start with an initial guess rate. I told you to start with 10%. Now there is a way to get to what should be the initial rate at which I start. Now this initial rate calculation will do only in the calculator. I am not going to show any steps in your notebook. So how you do that, I'll explain now. I need to start with a rate at which I get a closer to 0 NPV. If I don't get that, what will happen is, you'll first discount at 10%. You'll get a positive NPV, then do 12%, again positive, do 14%, again positive, do 16%, again positive. So you may have to keep repeating this multiple times. That much time will not be there in exam. Now one time you can note it down, how do you get a guess rate, but in exam you are not going to show. So now first, identification of initial guess rate. Identification of initial guess rate. Identification of initial guess rate. Now write ARR on average investment is equal to, ARR on average investment is equal to, ARR on average investment is equal to, on average investment is equal to average PAT by average investment. Average PAT by average investment into 100. That's your formula for your ARR on average investment. Now please listen. Sorry, just a minute, I have closed down the file. Now my average PAT is nothing but 15,500, which is every year cash flow, into 4. 15,500 into 4 is the cash flow which I am going to generate. How much do I invest in the project? Minus 50,000. This is my overall profits of the project. 15,500 into 4 minus 50,000, ignoring time value of money and all. In simple words, you will explain to someone saying that your investment is 50,000, you get back 15,500 into 4. This is the overall profits. 15,500 ARR on average investment. I am not going to go step by step saying that you calculate profit of every year. We are going to do it in a quick short way. It's not necessary to show this calculation, and also even if you make a mistake in this, it's not going to impact your final answer, just that your amount of reworking can increase. So 15,500 into 4 minus 50,000 divided by 4. This is my average PAT. 15,500 into 4 minus 50,000 divided by 4. My average investment is 50,000 plus 0 by 2. 50,000 plus 0 by 2. Your overall profits of the project is 15,500 into 4 minus 50,000. Y divided by 4 to get to the average profit. Whole divided by 50,000 plus 0 by 2. Get me this ARR. How much is the average PAT? %12. Any doubts on 12%? Anybody has any doubts on 12%? Initial guess rate equal to 2 by 3 of ARR. 2 by 3 of ARR. Initial guess rate equal to 2 by 3 of ARR. How much is that? 8%. Now, there's no rule why I'm doing 2/3. This is more or less will get you a closer to an IRR answer. That's the logic by which we do it. It may take us closer to the final answer. That's why we do 2 by 3 of ARR. Clear? Any doubts in this? Now, all this calculation will happen in the calculator. Now, in the calculator, do 15,500. You will look at the problem and quickly do this. 15,500 into 4 minus 50,000 divided by 4 divided by 25,000. All this will happen in the calculator. Nothing is going to happen in your notebook. 15,500 into 4 is your inflow, minus 50,000 is your outflow, divided by 4 is the average profit, divided by 25,000 is the average investment, into 100 if you want in percentage. So, you will get 12%. Clear? Any doubts in this? Now, I am going to start my calculation with 8%. Listen for some time. Here, cash flow, PVF at 8%, DCF. I know the final answer, but what you need to do in an exam scenario is that later on I will do PVF at some other percentage, XX, DCF. If I get one positive, one negative, my problem is over. If I don't get, then again I will have to repeat this. So, create your columns in such a way that you have space for 8 columns. 8 columns can give you 3 times flexibility to do the calculation. If still you don't get one positive and one negative, then I'll have to rewrite again here cash flow, PVF, DCF. So here what we are doing is we are at least ensuring that this year and cash flow remains same. Year and cash flow remains same. PVF, DCF, PVF, DCF, PVF, DCF, we can keep recreating as and when I need it. I need not recreate the year and cash flow column at least. PVF and DCF will be recreated as and when I need it. So, year cash flow, PVF at 8%, DCF we will do. We will see whether we get a positive NPV or negative NPV. Positive means you will have to increase the rate so that you get a negative NPV. Negative means you will have to reduce the rate so that you get positive NPV. I need one positive NPV, one negative NPV. Have space for 8 columns, but don't open them. Have space for 8 columns. If sometimes the problem can end with 6 columns, sometimes it can go to 8 columns, sometimes it may even go to 10 columns. So, I have most of the problems we will try to end it in 6 columns. That's why we start with an initial guess rate. But unfortunately, in any problem, it can even go to 10 columns or 12 columns. So, have adequate space for at least 8 columns. Clear? Any doubts in this? So, open only 4 columns, have space for another 4 columns. Open 4 columns with adequate space for another 4 columns. With adequate space for another 4 columns. Can we start? Now the cash flow is year 0, 1 to 4 together, annuity. 1 to 4 together. Year 0 outflow is 50,000, 15,500. In the calculator, 1 divided by 1.08 equal to m plus 4 times annuity. $3.312. Any doubts on this? Then I've got a positive NPV. I'll have to increase the rate. Let's do PVF at 10%. Should I do 9, 10, 11, 12? You'll understand as you do more problems. Should you increase by 1%, 2%? It all depends on how much NPV we are generating. So PVF at 10%. At 8%, we had a positive NPV of 1336. At 10%, I have a negative NPV of 865. PVF at 10% in the calculator. 1 divided by 1.1 equal to m plus equal to m plus equal to m plus. You keep on doing this. Can we proceed? Now listen for some time. There is a formula by which you can calculate IRR. First I'll explain the logical way and then I give you the formula. What is the NPV at 8%? 136, okay. NPV at 10%? Negative 865. These are the NPV we have generated. Now I need a level at which I am going to get 0 NPV. So if I put from a timeline point of view, 8% positive 1336, 10% negative 865, somewhere in between here is there is going to be a 0. In between there is going to be a 0 and I need to find the rate for that. In between there is going to be some 0. From positive 1336 we have moved to negative 865. From positive 1336 we have moved to negative 865 when I change the rate from 8 to 10%. Somewhere in between we will reach a 0. That is the point I am trying to calculate now. Now below this what we will normally do is change in rate. What is the change in the rate? 2%. Change in NPV? Think again. From positive you are going to negative. From positive we are going to negative. How much? 2 to 0, 1. So if you change the interest rate by 2%, NPV will change by 2201. If you change the interest rate by or discount rate by 2%, NPV will change by 2201, which is 1336 minus of minus. 1336 minus of minus. We get 2201, but I don't want the NPV to change by 2201. I wanted to change only by 1336. From positive 1336, I want it to be 0. So change in rate is 2 percentage, 22. Required change 1336, rate equal to, if 2 is equal to 2201, question mark is equal to 1336. If 2 is equal to 2201, 2, ignore the percentage for the time being, 2 equal to 2201, question mark equal to 1336. Do the cross multiplication, let me know. 2 equal to 2201, question mark equal to 1336. 1.2, 2 digits answer, 1.21. So if you change the discount rate by 2 percentage, your NPV will change by 2201. But if you change it by 1.21 percentage, your NPV will change by 1336, and my IRR is 9.21%. From 8, I add another 1.21 percentage, my IRR is 9.21%. There's a formula to this. I'll come to the formula in some time. But the point is, your discount rate has been changed by 2 percentage. A 2 percentage change in discount rate leads to a change in NPV of 2201. We are required to find out what rate will lead to a change in NPV of 1336, that is 1.21, and my final IRR is 8 plus 1.21. 8 plus 1.21. Now, this required change, I put 1336. No, from 865 also we can go to negative. So what I will do is, 2 is equal to 2201, question mark is equal to 865. Technically that will be 0.79 when you do. And the IRR is 10 minus 0.79. Either it's 8 plus 1.21 or 10 minus 0.79, whatever way you want to understand. It's either 8 add 1.21 or from 10 subtract 0.79. From 10 you cannot subtract 1.21, because from 10 when you start you have to move from negative 865 to positive 0. Here from positive 1336 you have to move to 0. Clear? Any doubts on this? Any doubts on the calculation? Now first do this. This is a timeline approach. NPV at 8, NPV at 10, and then I come to the formula. Any doubts on 9.21%? Can you proceed? Any doubts? Now write the formula. Done with this 9.21. Anybody has any doubts on this? Now write IRR equal to, this is the formula of interpolation, L1 plus L1 plus NPV at L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. L1 means lower rate, L2 means higher rate. What is the lower discount rate we have used here? Listen for some time. 8% plus. At 8%, what was the NPV? 13? Okay, 36 or 3. 1336 divided by 1336 minus of minus 865 into 10% minus 8%. When you do the calculation, please ignore the percentage. It's basically 8 plus 1335 divided by 1336 divided by 1336 plus 865 into 10 minus 8. Ignore the percentages for the time being. Do all the calculation and finally attach a percentage. Otherwise, there's a scope for confusion. You'll again get the same answer. It is basically the extension of that cross multiplication. In your cross multiplication, you would have done 1336 divided by 20 whatever number into 2. That is the second part of the calculation, that cross multiplication part, which you get 1.21. 8 plus 1.21 is 9.21. Any doubts on this? Clear? Can we proceed? We'll move to question E then. Rework if the annuity inflow is in advance. Any doubts till now? Anybody has any doubts till now? Now rework if the annuity inflow is in advance. Listen for some time. Advance means you are receiving at the beginning of the period rather than receiving at the end of the period. Now please listen. Year cash flow. Year 0, what's the outflow? 50,000. And after doing the outflow, immediately I'll get my inflow of 15,500. Because beginning of first year is nothing but today. At the beginning. So my project starts on Jan 1, 2011 and I immediately get the first inflow, Jan 1, 2011. That is what advance means. You receive it at the beginning of the period. So the first installment comes at the beginning of year 1. This is my second installment, this is my third installment, and this is my fourth installment. So you start the project and immediately get back the money. You don't even wait for some time, immediately you get back the money. Any doubts on this? Now after doing this, I am going to rewrite this question. The question is not what they have given, the question is like this: year 0 outflow is only 34,500 and year 1 to 3 annuity inflow 15,500. It's a 3-year problem rather than a 4-year problem. It's an inflow of 15,500 for 3 years and an outflow of 34,500. Now in the calculator you will do the guess rate and all, one positive, one negative, all of that we are going to start now. First write the cash flow structure like this and then we will do in the calculator the guess rate. Any doubts on this? If it's an advance, there is no outflow itself. See, practically nobody is going to pay 50,000 and immediately receive 15,500. If they say it's in advance, I'll say let's cancel the first installment and you tell me what amount I have to pay, because you're going to anyway give me back that amount. So technically it will become 34,500 of outflow and 15,500 of inflow for 3 periods rather than 4 periods. Clear? Any doubts on this? Get this? Any doubts on this? Now guess rate and all, I'm not going to allow you to do it in the notebook. In the calculator, what will you do? 15,500 into 3 minus 34,500 divided by 3 whole divided by, or this divided by what number? 17,250, half of 34,500, half of 34,500 divide by 17,250 into 100 to get the answer in percentage. What's the answer you get? 23.18. Now you will take 2/3 of this. What rate you get? 15.45. So I'm going to start my calculation at 16%. There's no rule that why 15, why 16, anything is fine. This is just to start our calculation. Now this problem, if you start with 10, then you will do 12, then you may do 16, then you may do 18. So a lot of rework can happen. Let's try at 16%, see what happens. So now write the cash flow, year cash flow structure. Have space for 8 columns. You will start at 16%. Have space for 8 columns, start at 16%, see whether we get positive or negative. How to start at 16 is what I have explained in the calculator. Start at 16%. Start at 16% calculation. depending on whether we get positive or negative, will increase or reduce the rate. Positive means I'll have to increase so that I get a negative answer. Negative means I'll have to reduce so that I get a positive answer. That's the rule. We need one positive, one negative. 2.246 is the factor. Any doubts on 2.246? Clear? Now try 18%. At 16% we had a positive NPV, at 18% we have a negative NPV. I need one positive NPV and one negative NPV to complete the question. One positive, one negative, that's the requirement. Any doubts on this? 313 and 803, any doubts? Now you know the formula, apply the formula or the timeline approach, whatever way you want to do it, let me know the answer. Either a formula or the timeline approach. Either through a formula approach or the timeline way, whatever way you want to do it. Answer is 16.56%. Any doubts on this? Clear? Can we proceed? Let's come to question F. Any doubts till now? Okay, now coming to question F. Again, it's multiple cash flows which are given in the question. Year 0, year 1, year 2, year 3. 3 years cash flows are given. Can you in the calculator do it and let me know what is the guess rate? Calculator. In the calculator, guess rate. You'll have to add all of that. Last time we used to multiply, now no multiplication. 450 plus 425 plus 400, 450 plus 425 plus 400 minus what? Minus 1000 divided by, please participate, 450. Any doubts you let me know. 450 plus 425 plus 400 minus 1000 divided by what? 3 divided by how much? Average investment is 500. 18.33% into 2 by 3. 12.22. So we'll start with 12%. This problem do with 2 decimals here. Value also 2 decimal because the amount is insignificant. It starts with 1000. So the initial guess rate is going to be 12%. Any doubts, let me know. The trickiest part of IRR is getting that initial rate. What rate to start with? That rate in this question we have decided as 12%. Have adequate space to do multiple calculations. Sometimes we may have to repeat it. Do a 12%, 2 decimal calculation. Your DCF will be 2 decimals. Please don't copy it from the board. There's no major calculation to be done. You do it. Let me know if at all there is a doubt. Two decimal calculation. Any doubts on 12%? Any doubts on the NPV answer? Now we have got positive NPV, increase it to 14%. Any doubts on 25.38? Let me know in case there are doubts or you want me to reduce the speed. Anywhere there are issues, please let me know. Do 14% then. How many of you are yet to get the workbook? Only one. Assignment book, everyone has also got the assignment book. Next, try at 14%. So you get a negative NPV of 8.53. Apply the IRR formula and get to the answer. Please apply the IRR formula. You will get it as 13.50%. If you apply the formula or the timeline approach, it's going to be 13.50%. Any doubts on 13.50%? Clear? Can we proceed? Any doubts on this? Everyone done? Okay, next two parts I'm going to do in the class. I'll leave it as homework, but I'll tell you the answer alone. You can note down the answer. The question number G is 14.99%. That's the answer. Excel directly gives you the answer. 14.99%. You can do it at home. Do your normal way of doing it in the ARR on average investment, all of that. Don't go by 14.99. The next one is, just a minute. %15.72%. Just a minute. Yeah, 15.72% is the next one. The answer is going to be 15.72%. You can complete this at home. Clear? Do question number 6 now. Again on IRR only. Do question number 6. Calculate the internal rate of a return on investment of 136 which yields the following cash inflows. Question number 6. Okay, let's first quickly calculate the guess rate in the calculator. Start doing it. Question number 6. I want the guess rate and then we do the calculation and all. How much is the initial guess rate? 8 point. So I'm getting it as 8.63%. In the calculator it will be 30,000 plus 40,000 plus 60,000 plus 30,000 plus 20,000 minus 136. This is the overall profits, which I think is 44,000. Divide by 5. Average profit is 8,800. Divided by 68,000. That's your average investment. Half of 136. Half of 136 divided by 68,000 into 2 by 3. How much you get? 8.63. Any doubts on this guess rate calculation? Otherwise IRR will become difficult. Any doubts on the guess rate? Start at 9%. Start calculating at 9%. Any doubts on 9%? Anybody has any doubts on the calculation? After 9, then move to 11%. Try at 11. We have got one positive, one negative. Use the formula and get to the answer. Done? Can you proceed? Now all the techniques we have discussed, now we'll focus on comprehensive investment decision problems. Okay, wherein the starting point is going to be calculation of cash flow. So I'll discuss on few critical aspects in relation to that. Okay, there are certain special items which come into cash flow calculation, so I'll explain each of them now. First item is depreciation. Now depreciation as an item does not impact the cash flow, but why it is considered in cash flow calculation is because of the tax benefit which a depreciation gives. So there's a tax shield attached to the depreciation, so that is why we consider depreciation in our analysis. Otherwise depreciation is an item which can be ignored. Assume a world where there are no taxes or a company which has tax exemptions because of section 10. So if there are tax exemptions for them, then depreciation will not come into picture in our cash flow calculation. So the purpose of analyzing depreciation is because of the tax benefit associated with. Next, opportunity cost. Opportunity cost refers to the cost of the next available opportunity. Now in our analysis, I need to consider opportunity cost. To give an example, somebody wants to set up a new factory. When you want to set up a new factory, either you can go for a rented building or you can go for your own building. So what happened is, this person had a own building and he is going to convert that into a factory now. He is going to convert that into a factory. For the own building, he is going to pay zero rent. He is going to pay zero rent, but capital budgeting will say that he was earning some rent. Earlier the building was let out, he was earning some rent of 40,000, 50,000, 1 lakh, whatever be that rent amount, that will be considered as a notional rent expenditure in our calculation. That is going to be considered as a notional rent expense in our calculation because of a concept called as opportunity cost, because that is an amount which I could have earned but I am not earning it. So any problem where there is an opportunity cost information, an opportunity cost is one where there will be a zero outflow, because you are not going to pay rent to yourself, so there is going to be a zero outflow. But in our analysis, I'll have to consider opportunity cost. Now there are some items called a sunk cost. A sunk cost is basically a cost which is already incurred by the company and it has no relevance, or it is not going to be impacted by the decision which I am going to take. To give an example, I want to set up a factory. To set up a factory, I need to know the product which I am going to manufacture. I am going to manufacture product A. I want to know whether there is a demand for this product or not. So I call somebody, tells him to do a market, tell him to do a market survey. He does the market survey and gives me a report. For the market survey, I have to pay 10 lakh rupees. I tell somebody to do a market survey for the product which I am going to introduce, and for the market survey I need to pay 10 lakhs. Should I consider this 10 lakhs as a relevant outflow in my analysis? When I do my capital budgeting analysis, should I consider this 10 lakhs as an outflow in our analysis? I tell somebody to do a market survey, he does the market survey and gives me the report. The market survey is being done just because you want to set up a factory. Should you consider this 10 lakhs in your analysis? I want your participation. What will you do? Will you consider it in your analysis? The answer may look like yes, but its answer is no. Now listen, the decision which I am taking is set up factory. Yes, no. If I am going to set up the factory, I have to pay 10 lakhs. If I don't set up the factory after reading the report, again I have to pay 10 lakhs. So this is technically called as a sunk cost, because this cost is not going to change by the decision you take whether to set up a factory or not set up a factory. The amount incurred will be 10 lakhs and it's not going to be impacted by the decision which you take. When will this 10 lakhs be a relevant expense? this 10 lakhs can become a relevant expense if the market survey is yet to be done. Or to the market survey guy, I say that if your report is acceptable to me, I set up the plant, I'll pay you money. Otherwise, I'm not going to pay you the money. So if at all I have an agreement like that, then only it is a relevant expense. So technically, market survey is a sunk cost. Sunk cost means historical cost. It does not change by the decision you take. The decision is whether to set up a factory or not. Yes also, pay it. No also, pay it if the market survey is already done. If someone has already done the market survey, so that's technically called as a historical cost. Whether you are paid for it, not paid for it, does not matter. This is an amount which is already incurred by the company. Clear? Any doubts on this? So this is technically called as a sunk cost. Working capital I'll explain later. Okay, some of this I'll explain later on. Let me go to the steps now. Steps for calculation of cash flow. Now listen, the first step is initial outflow. Now when I'm going to set up my project, there are going to be two things which I need. One, I need land, building, plant and machinery. Second, I need raw material, cash to run my operations. One, I need land, building, plant and machinery. Second, I need raw material and cash. Land, building, plant and machinery is called as capital expenditure. Raw material and cash is called as working capital. So when you start a project, your money will be blocked in two things. One is capital expenditure and second is working capital. So this is your initial outflow. When somebody wants to set up a new factory, new shop, anything which you want to do, two places money will be stuck. One is fixed assets, second is current assets. Fixed assets is something which is once bought, will continue to be there. Current assets will keep revolving and rotating, and it will keep, every year it will keep changing depending on your level of activity. So the first thing is fixed assets, second thing is current assets, technically called as working capital. Capital expenditure and working capital. Any doubts on this? Any doubts on this? So this is my initial outflow. Second, by doing this expense, every year I'll get something which is revenues less what? All cost other than depreciation, PBDT less depreciation, PBT less tax, PAT add back depreciation, CFAT. Now the CFAT will undergo a little bit of changes later on. Sometimes it's not necessary that I buy all the machinery on day 0. What will happen is you will buy a machinery worth 200 lakhs today, and at the end of third year another machinery worth 10 lakhs, at the end of fifth year another machinery worth 20 lakhs. So you may buy more machineries if the company needs it. That item will be adjusted after CFAT, because purchase of machinery is not going to go into your P&L. It is not going to come in P&L. So it's not a tax deductible expense. It's not going to come in P&L. The depreciation will come in P&L, which is anyway already written. So after CFAT, you can have an item called as less purchase of new machinery. CFAT, after that you can have a new item called as purchase of new machinery. You can also have another item called as payment for original machinery. What is payment for original machinery? When you bought the machinery, you did not make the payment. When you bought the machinery, you did not make the entire payment. You made only 1/3. Balance 1/3 will be written now. Balance 1/3 will be written later on. Whatever the question talks about. So CFAT will be adjusted for purchase of additional machinery and payment for original machinery. This is from capital expenditure point of view. So from capital expenditure point of view, there can be a purchase, there can be a payment, there can be a purchase and payment. From working capital point of view, when I started my operation, my working capital was only 2 lakh. At the end of year 1, the working capital can increase, can also decrease. If it increases, more money is blocked, outflow of money, outflow of money. If money is released, that is your working capital comes down, it's inflow of money. So working capital at the end of year 1, year 2 can be an inflow as well as an outflow, depending on whether more money is blocked or money is released. Sometimes money can get blocked, sometimes money can get released. Clear? Any doubts on this? Working capital basically refers to the amount of funds blocked in a company. So that's an outflow on day 0. this outflow can increase, can decrease. So this is the calculation. Add or less, it can be add or less, increase or decrease in working capital. It can be added if there is an increase, it can be deducted if the, sorry, it can be added. Your cash flow can increase if there is a decrease in working capital. When there is a decrease in working capital, it's inflow of money. When there is an increase in working capital, it's an outflow of money. Why outflow? You are buying more raw material. Your money is blocked in debtors. So all these are outflow of money. Any doubts in this? Now, whatever money is blocked on day 1 will get released once the project is over. It could be year 10, year 15. That's technically called as terminal flow. In the terminal flow, you'll have two things. One, recapture of working capital. What is recapture of working capital? Is whatever money is blocked on day 0 is released at the end of year 5. Why am I writing at the end of year 5 as well as year 0? Year 0 money blocked is 1 lakh. Year 5 money released is 1 lakh. But this year 0 1 lakh and year 5 1 lakh is not same, because the time value of money changes. The value of the money keeps changing with time. That's why we write it at both the places. On day 0 it is blocked. On year 5 it is released. If the problem is silent, same amount gets blocked, same amount gets released. If the problem specifies something, we will accordingly do whatever the question says. The second thing is, for the machinery building, will you get back the original amount again? If you bought machinery worth 100 lakhs, will you get back 100 lakhs? What will you get back? Technically called as salvage value. So now listen. Initially I would have invested 100 lakhs. My salvage value is 10 lakhs. So this salvage value is what I will get back. The salvage value has to go through one set of adjustment. What is that adjustment is? Sale value 10 lakhs. You are going to sell the machinery for 10 lakhs. There will be a book value for the machinery. What is the book value for the machinery? Is 100 lakhs minus depreciation of year 1, depreciation of year 2, depreciation of year 3, 4, 5. After this, the value can be 20 lakhs. Can also be 5 lakhs. I'm just giving two imaginary number. It can be higher than sale value. It can be lower than sale value. If it's higher, tax loss. Capital loss. There's a loss of 10 lakhs. This is capital gain. You may learn this in capital gains chapter in tax. So there's a capital loss of 10 lakhs. There's a capital gain of 5 lakhs. If there is a loss, finance says that you save taxes. If there is a gain, you pay taxes. So whenever there is a loss for a company, that loss can be technically offset against few other profits, and indirectly you are saving taxes. So when I report a loss, this loss will be offset. You will learn set off and carry forward of losses. So this loss can be set off against some other profit, and because of this, company will indirectly save tax. So on a loss you save tax, on a gain you pay tax. Any doubts on this? On a loss, unless the question tells you otherwise, some question will say that there is no tax benefit available on the losses, or something will be mentioned in the question. If the problem is silent, on a loss you are going to save tax, on a gain you are going to pay tax. Now tax saved, let's assume 30%, 3 lakh. Tax paid 1,50,000. In one case I will save 3 lakhs of tax, in another case I will pay 1,50,000 of tax. Now please listen, this is a cash flow, this is not a cash flow, it's just a book entry. This is also not a cash flow. Gain or loss is only your books of accounts. This is again a cash flow. Either you save tax or pay tax. It's saving tax is like a cost reduction. Paying tax is like an extra outflow for you. So technically both are cash flows. My final net salvage value is 13 lakhs and 8 lakh 50,000. How 13 lakhs is 10 lakh plus another 3 lakh of saving, 10 lakh minus 1 lakh 50,000 of payment. So you will not take the salvage value as it is, you will have to do an adjustment called as net salvage value. You will have to do an adjustment called as net salvage value. Clear? Any doubts on this? Any doubts on this? Terminal flow. This is the calculation of net salvage value. Sale value less book value, gain or loss, tax paid or tax saved, and net salvage value. Sale value plus tax saved minus tax paid. Be very careful, there is a gap in between. In a hurry, people will do capital gain minus tax as net salvage value. Please be careful, there is a gap in between. The gap is given to tell you that it is sale value plus tax saved or minus tax paid. Only one item will be there. Either there will be a tax saved or a tax paid. Clear? Any doubts on this? After getting all this cash flow, you will consolidate and calculate NPV, which is year, cash flow, PVF, DCF. Till now, all problems, year and cash flow was given to you. Now you are going to calculate it. That is what we are going to do now onwards. We will calculate the year and cash flow and then calculate whatever the question says. If they ask for payback, then year, cash flow, cumulative cash flow. If they ask for discounted payback, year, cash flow, PVF, DCF, CDCF. If they ask for ARR, year, cash flow, depreciation, PAT. So whatever they are asking, we will do. If the problem is silent, you do only NPV. If the problem is silent, we do only NPV. We do NPV. Positive NPV, go ahead with the project. Negative NPV, reject the project. Any doubts till now? Now just go through the steps. I'll then again explain the principles and then I go to a problem. Page number 26. Go through the steps in page 26. Okay, now we'll revise the steps again. Your step 1 is initial outflow, two components of outflow. One is capital expenditure and second is working capital. Capital expenditure is basically the fixed assets which you buy. Working capital is basically the current assets which you need. Current assets minus current liability. Step 2 is in between flows. It starts with what? Revenues less all cost other than depreciation, PBDT less depreciation, PBT less tax, PAT add depreciation, CFAT less payment or purchase of additional machinery, payment of original machinery or purchase of additional machinery, and the next item is increase or decrease in working capital. That will give you the net cash flow. This cash flow can be negative also. It's not necessary that it has to be positive. Step 3 is terminal flow. Two items. First item is net salvage value and second item is recapture of working capital. Step 4 is you consolidate and calculate NPV, year, cash flow, PVF and DCF. Net salvage value calculation starts with what? Sale value less book value, gain or loss, tax paid or tax saved, leave a line and net salvage value. Now certain other principle. Now when I do a project, what will happen is, lot of times if I am doing a project, overheads will get distributed to various projects using a overhead absorption rate. So what companies will do is, ITC if they are doing a new project, this new project will get a share of corporate overheads allocated to them. What is corporate overheads? There is a corporate office which also has its own expenses. Now this expense needs to be distributed to the various projects. So all this distributed overheads, apportioned overheads, general overheads, allocated overheads are not specific to the project. They are ignored in our analysis. Any apportioned, allocated, general, corporate, all these are not related to the project itself. But why do I distribute? Bharadwaj Institute may distribute something to the CA classes. It may not be linked to the CA classes expenses, but still they will distribute it because there is a corporate general expense which there is accounts and finance team which sits out. This accounts and finance team has to be paid salaries. Now whether I do this project or not, they will continue to get the same amount of salaries. What normally problem will do is, they'll say we'll distribute some salaries to this project. All this apportioned, general, allocated expenses are irrelevant. Then what is relevant? Relevant is my general expenses or my corporate expenses before this project was 500 lakhs. But because of this project, it is going to increase to 505 lakhs. Then that extra 5 lakhs only is relevant. What is the real increase? Because what the problem will do is, companies normally will not see the increase. They'll say 505 divided by 5, every project 100 lakhs. They'll just do every project 100 lakhs, and if I consider 100 lakhs in my analysis, my NPV can become negative. What we will take is only the incremental overheads which comes in, not the overall expense. Clear? Any doubts on this? What matters is the extra expense which a company incurs and not the overall expense. Clear? Any doubts on this? Another important principle is reward exclusion principle. When we did costing, in the cost sheet, did we write dividends as one of the expense? No. Did we write interest? No. I explained it saying that for comparison purpose, if I consider dividends, another company, if I ignore dividends, another company may not pay dividend, but they may pay interest. Coke can have loans in their books, Pepsi may not have loans in their books. So in case of PepsiCo, interest expense will not be there. In case of Coke, interest expense will be there. Now these interest expense and all will never come in the cost sheet, because if it comes in the cost sheet, it will lead to a wrong decision making, because one company will say their cost of production is higher than the other company, whereas in reality both companies COP may be more or less similar. So expenses which are related to financing are ignored in the cost sheet. Similarly, it is also ignored in your capital budgeting analysis. Dividends ignored, interest on loans ignored. You ignore it in your analysis. Clear? Any doubts on this? Interest on long-term loans, dividends, that's technically called as financing cost principles. So you are going to ignore interest on long-term debt and equity dividend should be excluded from the analysis. You should never bring it in your analysis. Clear? Any doubts on this? The logic is same as what we have done in cost sheet. Whatever I did in cost sheet, the same rules apply here. So few critical things when you solve a problem: ignore allocated, apportioned, general, corporate overheads. Ignore interest expense. Purposefully they'll give you interest expense in a question. Clear? Any doubts on this? Let's move to questions now. Let's come to question 7. Metro Travel Corporation Limited is planning to purchase a machinery that is useful in manufacturing bus engines. Cost of machine is 10 lakhs. Useful life period is 5 years. Profits every year at a declining rate of 1 lakh per year, starting with 5 lakhs. Salvage value 50,000. Book value 2 lakhs. SLM, tax rates. Should the company buy the machine? Okay, the final requirement of this question is we need to decide whether the company should buy this machine or not. So in order to do this analysis, we'll have to go through those series of 4 steps. In step 1, I'll find out the initial outflow. Step 2, in between flows. Step 3, terminal flow. Step 4, consolidate and calculate NPV. Positive NPV, go ahead. Negative NPV, reject it. Let's start. Step 1, initial outflow. Step 1, initial outflow. initial outflow, particulars and amount, particulars and amount. Point number 1, capital expenditure. How much is the capex for this project? How much? 10 lakhs. Capital expenditure 10 lakhs. Point number 2, working capital. I'll write it as a format. Some question it will be there, some question it may not be there. Working capital. Sorry, your capital expenditure you have to put it in brackets, okay? Initial outflow 10 lakhs in brackets. Capital expenditure 10 lakhs in brackets. Working capital? Anywhere, any reference on working capital? No, 0. Capital expenditure is 10 lakhs, working capital is 0. Any doubts on this? Step 2, in between flows. Particulars and 5 columns, year 1, 2, 3, 4, 5. Particulars and 5 years. Now let's look at the question. My step 2 starting point can be revenues, can be PBDT, PBT, PAT or CFAT is directly given. Now what is the information they have given? It generates profits every year at a declining rate of 1 lakh starting with 5 lakhs in the first year. So it's basically 5, 4, 3, 2, 1. That's the amount you are making. Now what is this amount? Is it revenue, PBDT, PBT or PAT? What is it? Revenue, PBDT, PBT, PAT. Now it says it generates profits. So it can't be revenue. It can't also be PBDT because it's profit. Profit means after depreciation. Now it can be one of these two. That's your assumption. It generates profits at the rate of 5 lakhs at the rate of declining rate of 1 lakh starting with 5 lakhs in the first year. It's your wish whether you want to take it as PBT or PAT. It can't be PBDT. It can't be PBDT. The moment somebody says profit, I will understand profit is after depreciation. Profit can be before tax or after tax, that I may not be very clear. But if somebody tells me we are earning a profit of 2 lakhs, then that profit is indirectly understood as after depreciation. Whether it is before tax or after tax is our assumption. I'll take it as before tax and we'll write a note on this sometime. So PBT will take it as 5, 4, 3, 2, 1. That's our assumption. It can be PBT or PAT. So start with PBT, PBT. PBT less tax. less tax. What's the tax rate given in the question? 50%. 250. After PAT, what we do? Add depreciation. Now go through it and let me know what is depreciation. We'll discuss on it. What is the depreciation amount? 1,90,000. 1 lakh. How much is the depreciation amount? 1. It's not 190. It's 160. Now please listen. The normal formula is cost minus salvage value, perfectly fine. But they themselves have mentioned that book value at the end of 5 years is going to be, which means in 5 years you can charge depreciation of only 8 lakhs. 10 lakhs is the cost of the machine, and the question specifically tells me that at the end of 5 years the book value is going to be 2 lakhs. If they had not mentioned this, it would have been 10 lakh minus 50,000 divided by 5. They themselves are stating that book value at the end of 5 years is going to be 2 lakhs, which indirectly indicates that for a period of 5 years you will charge depreciation of only 8 lakhs. The depreciation is going to be only 8 lakhs for a period of 5 years. Any doubts on this? This is because the question says book value at the end of 5 years is 2 lakhs. If that was missing, then what you said is correct. 10 lakh minus 50,000 divided by 5 years. 10 lakh minus 50,000 divided by 5 years is perfectly right. 10 lakh minus 50,000 divided by 5 years is perfectly right if the book value information was missing in the question. They have made it very clear in the question saying that at the end of 5 years there is going to be a value, and that value is how much they have said? 2 lakhs. So depreciation in brackets 10 minus 2 divided by 5. 10 lakhs minus 2 lakhs divided by 5. Any doubts on this? Clear? Any doubts? Now write note. It is assumed that the profits given in the question profits given in the question is PBT. It is assumed that the profits given in the question is PBT. Clear? Any doubts on this? Next, step 3, terminal flow. Step 3, terminal flow. Particulars and 2 amount columns, inner column and an outer column. Particulars, amount. Point number 1, recapture of working capital. Recapture of working capital. Whatever is blocked will get released. Recapture of working capital. How much was the money blocked? 0. So recapture of working capital is 0. There is no working capital in this question. Recapture of working capital 0. Point number 2, net salvage value, and underline that. Net salvage value and underline that. Below that, sale value less book value, all of that has to be done. Sale value, you will write these amounts in the inner column. Sale value, at what value are we selling the asset after 5 years? How much? 50,000. Sale value is 50,000 less, what do you subtract? Book value, which is given in the question. Otherwise, book value is original purchase price minus depreciation of year 1, 2, 3, 4, 5. You deduct it like this. What is the book value? 2 lakhs. Capital gain or loss? Loss. Capital loss 1,50,000. Capital loss 1,50,000. On the loss, are you going to pay tax or save tax? Pay or save? Save. Next, tax saved. Tax saved. How much? And leave a line, net salvage value, because you may do it in a hurry as a continuity. Net salvage value. Net salvage value. What's net salvage value? Sale value of 50,000 plus tax saved of 75,000. Sale value of 50,000 plus tax saved of 75,000. And take that amount in the outer column and put a total. Any doubts on this? Clear? Step 4, calculation of NPV. Step 4, calculation of NPV, calculation of NPV, 4 columns, year, cash flow, PVF at some discount rate would have been given in the question. Cost of capital or discount rate, something would have been used. PVF at 12%. Now, the moment you come to this working note, you should not see the question beyond this. Only for the discount rate, I'll see the question. Everything else is available in your notebook. You need to exactly copy paste them. Year 0, go to step 1 and tell me the outflow. Year 0 is step 1, 10 lakhs. Year 0, 10 lakhs. This is what used to be given in the problem till now. Whatever problems you have done, they used to give this number. Year 1, go to step 2. 4 lakh 10,000. Year 2, again step 2, 360. Year 3, 310. Year 4, 260. Year 5 is step 2 plus step 3, because step 3 is the last year. Terminal flow is the last year. So what figure you see in step 2 and add the step 3 figure, your terminal flow. So it is 2,10,000 plus how much? 125. So it adds up to. Now do a 12% and let me know the NPV. Positive, go ahead. Negative, reject it. Fourth step is the easiest of the lot. Any doubts on 229,075? Clear? Any doubts? Can you proceed? Now write the conclusion. The company should buy the machinery. The company should buy the machinery. Company should buy the machinery as it results in company should buy the machinery as it results in positive NPV of, should buy the machinery as it results in positive NPV of 229075, as it results in positive NPV of 229075. Any doubts? Clear? Can we proceed to the next question? Go through question 8. Okay, now they've given details about a company which wants to introduce a new product. Some expenses details and all are given. Finally, they want us to answer, should the project be accepted? Again, series of 4 steps. Step 1, initial outflow. Step 2, in between flows, terminal flow, and finally we decide whether positive or negative, and then go ahead with the decision. Step, let's start. Working note 1, initial outflow. Working note 1, initial outflow. Particulars, amount in bracket in lakhs. Amount in bracket in lakhs. We'll solve the entire problem in lakhs rather than writing so many zeros. Amount in lakhs. Particulars, amount in brackets in lakhs. Let's start with capital expenditure. Capital expenditure. How much is the initial payment? 120. Capital expenditure is 120. There could be an additional machinery that will not come here, that will come later on. Capital expenditure is 120. Working capital, how much? Both are in brackets. Capital expenditure 120, working capital 15. So this is initial outflow is 135. Initial outflow for the project is 135. Any doubts on this? Working note 2, in between flows, particulars and 8 columns. Particulars and 8 years. Working note 2, in between flows, particulars and year 1 till year 8. particulars on 8 columns. Now let's look at the question. They've said X Limited, an existing profit making company, is planning to introduce with a life of 8 years. Some information is given. The 100% capacity of the plant is 4 lakh and the production and sales volume is expected to be 20%, 30%, 75% and 50%. So basically I can get to know what is the unit sold. For example, in the first year the unit sold is 4 into 20%, 0.8 lakh. I am calling it in lakhs. So in the first year you will sell 0.8 lakh units. Second year how many units you will sell? 1.2 lakh units. Any doubts in this? First year 0.8, second year 1.2, third year, fourth year, fifth year. All these 3 years it is going to be 3 lakh units. 4 lakh into 75%. Any doubts in this? 4 into 20%, 30%, 75% and 50%. 4 into 20, 30, 75 and 50. This will give you the unit sold. Is the selling price available? 100. So I have the selling price, I have the unit sold. So this problem will start with revenues. We will start with revenues. Some problem we start with PBDT, PBT, PAT. This problem we are going to start with revenues. In revenues also I'll first start with unit sold and then write revenues. So one thing you'll have to do in the right hand side, you'll have to write in lakhs. Whenever you solve a problem in lakhs, thousands, on the working note in the right hand side you'll have to write in lakhs. Now start with units sold. Units sold. Units sold is 0.8. 4 lakhs into 20%, 0.8. Then we have 1.2, 3, 3, 3, 2, 2 and 2. 3, 3, 3 and 2, 2 and 2. Any doubts on this? Revenues multiply with 100. Revenues any doubts till now? What is the PVR mentioned in the question? 60%, which means my variable cost is 40%. So from revenues, now listen, from revenues I'll deduct variable cost, I will deduct fixed cost, I will deduct advertisement. If I deduct all of this, I'll get PBDT. From revenues, we will deduct variable cost, fixed cost and advertisement. Once I deduct all these three, I will get PBDT, profit before depreciation and taxes. Clear? So now look, less variable cost, less fixed cost, less advertisement. complete till PBDT. Any doubts till PBDT? Can I proceed? Sure. Any doubts till PBDT? Now, let's come to depreciation. Listen for some time. This original machinery was bought on day 0. What will be the depreciation of this machinery every year? Depreciation for original machine every year. Original machine depreciation for every year. How much? I want everyone's participation. What is the depreciation for the original machinery every year? It's 120 minus 0 by 8, 15 lakhs. Additional machinery, what will be the depreciation and for which years? So 3 to 8, what is the depreciation? 10 minus 1 by 6 years. It's 10 lakhs minus 1 lakh divided by 6 years. You buy at the beginning of the third year, 4th year, 5th year, 6th, 7th, 8th. For 6 years, you can charge depreciation. So it's 10 lakhs minus 1 lakh divided by 6 years. Now you write it like this: less depreciation of original machine and depreciation of additional. Depreciation of original, depreciation of additional. Original is negative 15 for all the 8 years. And additional is get PAT. No, so what is sale value all about? Sale value is your salvage value, no? What is salvage value of a machinery? So same, 10 lakh minus 1 lakh still. Whatever way you want to interpret it. You interpret it as book value after 8 years or salvage value after 8 years. Net the answer is same, no? 10 lakh minus 1 lakh. So the normal understanding is sale value means salvage value. So last problem they specifically gave book value in the question. No problem, they'll give you book value. Most probably they'll give you the salvage value, and some question will specifically say depreciation has to be 1 lakh per year. If they say, I have to follow whatever the question says. So whenever the problem is silent, you follow SLM. So problem is silent, 10 minus 1 divided by 6 years. Why minus 1 is your salvage value or scrap value or sale value. Your sale value is nothing but scrap value, no? At the end of 6 years or at the end of 8 years, whatever value at which you sell it, you can call it a sale value, salvage value, scrap value, different names you can give to it. That if the question has to give that information, for example, last problem, the question specifically gave the information saying that book value has to be 2 lakhs after 5 years and you are going to sell it for 50,000. Now this question could have made an reference saying that the sale value after 8 years will be 1 lakh, but depreciation has to be provided at the rate of 2 lakh per year, at the rate of 1,50,000 per year. Then in the end you may have a profit or a loss. Wherever the problem is silent, I can't do much about it. So the problem is silent, whatever sale value they give, technically that's a salvage value. Any doubts on PBT? Now listen for some time. Now what is the tax rate given in the question? Now let's take year 2. Year 2, 26 into 50% is 13. Whatever I get, I put it in brackets because I am going to deduct it. Negative 13 into 50%. Negative 13 into 50%. Negative 6.5. I am going to put it in brackets. It will become plus 6.5. Negative of negative. Minus 13 into 50% is minus 6.5. Whatever number you get, what I did is 26 into 50%, we got 13, I put a bracket here. Negative 13 into 50% minus 6.5. Minus of minus will become plus. Minus of minus is going to become plus. So wherever there are losses, you are going to save tax. That's where that plus 6.5 has come. Why plus 6.5 is coming mathematically is because you are making losses, and when you make losses you are expected to save tax. Clear? Any doubts on this? And the important reference which is given in the question is existing profit making company, which means this loss will be set off against the profits which they have been making, and these profits will come down. Accordingly the tax outflow will come down. So whenever a company makes a loss, that is beneficial from a tax point of view. In fact, practically whenever a company is thinking that they may make a huge profit, they will end up buying certain machinery at the end of the year. When you buy machinery even on March 30, technically as per Income Tax Act, you will be allowed a depreciation for 6 months. It's either 12 months or 6 months. So even if you buy a machinery on March 30, you can charge the depreciation as 10 lakhs into the rate into 6 by 12. So accordingly the profits will come down significantly. So there are certain assets which even have a 80% depreciation, 100% depreciation. Examples, windmill. When you buy windmill, you can claim a 80% depreciation or a 100% depreciation. So what will happen is, if I feel that I may report a huge profit, I'll purposefully buy a windmill on March 30, on March 29, on March 28, somewhere towards in the month of March. Why do I buy in the month of March? Is to reduce my profits. And accordingly my tax outflow. So any company which reports a loss can set off that loss against any other profit it makes, or it will be carried forward and set off against future. Now how it is carry forward, how will carry forward work is, at home you may do a carry forward problem. At carry forward what will happen is this will be 0. No payment, no saving. Nothing is going to work out because you are going to carry forward the loss. Second year what will happen is, what is the profit you have reported in the second year? 26. Income tax will say not 26, it's 26 minus 13. Why minus 13? You're carrying forward the loss and setting off in the next year. You'll learn all of this in income tax. So 26 is not the loss, the profit is not 26, the profit now will become 13 and you'll pay a tax of 6.5. So it can be a carry forward or it can be set off in the same period. Now if it's carry forward, year 2 negative 6.5. If it's not carry forward, year 1 positive 6.5, year 2 negative 13, both again add up to 6.5 only. Why this differently written? Because of time value of money. Your time value of money also has an importance, because what you get in year 1 is not same as what you get in year 2. Clear? Any doubts in this? So wherever there are losses, you will have to consider tax saving. Wherever losses are there, we will have to consider tax saving. Any doubts in this? Yep.
There is no carry forward option. You have to pay 6.5 tax should be in the first year.
Save. You're saving.
Yeah. Why are we even paying tax? It's a loss, right?
I'm not paying. I'm plus 6.5. Plus 6.5 reduces my loss. It's a saving. I'm not paying. I'm adding this amount. No, plus 6.5.
Yeah.
So you're not paying tax. You're saving tax. How do you save taxes? You have your another business where the tax was to be paid as 100 lakhs on its profits. Now instead of paying 100 lakhs, you'll pay only 94.5. Sorry, 93.5. Why 93.5? This loss will be set off there. Clear? Any doubts on this? Now write less tax at 50%. Less tax at 50%. So this will become plus 6.5. Why plus 6.5 is just math. Math says minus 13 into 6.5 is minus 6.5. Minus of minus has become plus. Next year, negative 13. Negative 68.75. 68.75. 68.75. 41.75. And PAT. PAT is PBT adjusted for tax. Wherever saving is there, indirectly it's getting added. That's how we have devised the format. What is the PAT of first year? If you do that alone correctly, everything else is fine. How much? Negative 6.5. That's the only tricky part. It's negative 6.5. Basically, your tax has reduced your losses. Why they have reduced your losses? That's because you're saving tax. Then add back depreciation. Add back depreciation. $58 point. Now, any doubts on the CFAT figure? This CFAT may undergo two changes if at all the question talks about any increase or decrease in working capital. Anywhere, any information on working capital apart from that initial 15. Anywhere have they talked about working capital? Yes, no. No, so working capital doesn't change, leave it. Any payment for original machinery which was pending? Did they give any payment track record? Nothing, leave it. Any purchase of additional machinery? Yes. So less purchase of additional machine. Purchase of additional machine. Purchase of additional machine. How much? 10 lakhs. Which year? Third year. Purchase of additional machine. Which year? Read it carefully. Which year is the purchase of machinery? Beginning of year 3. My original machine was purchased at beginning of year 1. My original machine was purchased on beginning of year 1. Year 1 beginning is the first day of the year. Beginning of year 1. Which year did you write the cash flow? Year 0 or year 1? Year 0. Finance assume all cash flow to happen at the end of the year. If it is 10 lakhs in the third year, then in the same year you cannot have a depreciation also. So it's not third year, it is second year. You correct it with a different color pen. Beginning of year 3 is end of year 2. Beginning of year 3 is end of year 2. So it's not third year, it is second year. The cash flow doesn't happen in the third year, it happens in the second year. Technically, the initial purchase of machinery is beginning of year 1. Technically, it is beginning of year 1. Now, after correcting that, get the RCFAT, revised cash flows. 8.5, 18, any doubts on this? Clear? Can we proceed? Now, this is the first time you are solving this problem, so I didn't tell you the shortcut way and all. In case I assume that the cash flow is going to be same for every year, if it's going to be same, so I wouldn't have written like this. I would have written year 1, year 2, year 3 to 5 together, because you see everywhere the same amount. Why should I create 3 columns like that? Year 3 to 5 would have been clubbed together. Year 6 to 8 also would have been clubbed together. But this is, you will have to imagine all the cash flow and see that nothing is going to be separately written. If that purchase of additional machine was in third year, then you cannot club 3, 4, 5. Then 3, 4, 5 can't be clubbed together, because year 3 will have a different cash flow, year 4 will have a different cash flow. If every year it is going to be same, if you can imagine the entire problem and feel that every year it is going to be same, then you are going to club it and do it together. In case you have a confusion, then leave it, end up doing 8 years separately. Let's not worry about it. It may take you some more time, but let's do it as year 1, year 2, year 3. As you do more problems, you may understand when to combine the columns and when to do it separately. So in this question, I could have created it as particulars year 1, year 2, year 3 to 5, year 6 to 8. When you do 3 to 5, you are not going to multiply any of this with 3. You are going to write 3 lakhs, 300, 120, 16, 10. Everything is going to be same. Just that when you come to your step 4, year 3, you will copy the same number. Year 4, you will copy the same number. Year 5, you will copy the same number. It does not mean you have to multiply with 3. Be very careful. Last class when we did annual cash flow calculation, we got the cash flow and wrote the same amount for 5 years. I did not multiply with 5 anywhere. So you are not going to do any multiplication with 3. This problem could have been made as 5 columnar format, particulars year 1, year 2, year 3 to 5 together, year 6 to 8 together. Clear? Any doubts on this? Next, step 3, terminal flow. Working note 3, terminal flow. Particulars and one amount column. Inner column will not work here. I have to do a separate working note only. Particulars and amount. Particulars and amount. Point number 1, recapture of working capital. Recapture of working capital. Recapture of working capital. How much? Again in bracket in lakhs, okay. 15 lakhs. Recapture of working capital 15 lakhs. Point number 2. NSV in bracket note 1. I'll have to do a separate calculation. There are 2 machinery. NSV in bracket note 1. We'll do it as a separate calculation and then write a single amount here. NSV in bracket note 1. Come down note 1. Calculation of NSV. Leave some 3 lines. Calculation of NSV. Calculation of NSV. Particulars, original machine, additional machine. Particulars, original, additional. Same 5 things you have to analyze. You'll have to separately do it for original as well as additional. What's the first starting point? Sale value. Original machine is sold for what value after 8 years? Original machine after 8 years. Original. Yeah, please participate. What is the sale value of original machine? Equal to cost of removal. Net you are going to get 0 out of it. Whatever I sell it for, that is going to be spent in cost of removing it. So sale value of original machine is 0. Additional machine will be sold for 1 lakh. Original 0, additional 1 lakh. Original is 0, additional is 1 lakh. Less book value. Now please listen. Original machine was bought for 120. In the calculator, 120 minus 15 into 8. Every year you charge 15 lakhs depreciation. 120 minus 15 into 8. What is the book value? 0. Additional is 10 minus 1.5 into 6. 10 minus 1.5 into 6. The value post depreciation. How much? 1. Gain. The gain is 0 and 0. There is no capital gain, no capital loss in this question. Gain is 0 and 0. Tax will also be 0 and 0. Any doubts on this? Let me know in case there's a doubt here. Gain is 0 and 0. Tax is 0 and 0. NSV is also 0 and it's 1, not 0 and 0. NSV is 0 and 1. It is sale value plus tax or minus tax. Sale value plus or minus tax. NSV is 1. Any doubts on this? Now we'll go to the other working note and write 1 here. So when you are when I have to sell a machinery, I want somebody to pick the machinery from my factory, so I have to incur a cost associated with, that's called as cost of removing the machinery. 15 plus 1, 16 lakhs is the NSV, or is the total terminal flow. 15 plus 1, 16 is the total terminal flow. Any doubts on this? 15 plus 1, 16. Any doubts on this? Year, cash flow, PVF, DCF, complete now. Calculation of NPV. We'll do the calculation with 2 decimal. When you come to this working note, just to get the rate, you will see the question. Beyond that, don't look at the question. PVF at what rate? PVF at 12%. Beyond this, don't look at the question. Everything is going to come from your working note. First year was how much? 8.5. Second year was 18.18. Done. We'll write the conclusion then. Any doubts? Any doubts on the NPV? 136.05. Now write the conclusion. Right, the company should go ahead with the project. The company should go ahead with the project. Go ahead with the project as it generates positive NPV of 136.05. Clear? We'll end with this. We'll continue in the next class.